We have just a few minutes left in our trading day. That means it's time for the big picture. So we will welcome in our team from Charles Schwab. Joining us today is Joe Mazzola, the head trading derivatives strategist at Charles Schwab, and Kathy Jones, our chief fixed income strategist at the Schwab Center for Financial Research. Kathy, we'll start with you today. Just some takeaways on the choppy day that we've seen so far.
Yeah, we got a lot of data today. That was pretty significant. We got the JOLTS data, the job openings and labor turnover survey. And what we saw there was that a slowdown in the labor market was confirmed, particularly with the rise in layoffs. That was a surprise. Not only was this month up a lot, but last month was revised up. So we're starting to see the labor market give way, and I think that that's important in terms of expectations about Fed policy. And then the other information we got was the Beige Book later in the day. And for the bond market, that's important because it describes economic conditions in the various districts, and that informs how the various governors will vote, or the bank presidents tend to vote in line with what they're hearing in their districts. And what they heard was kind of stagnant to slower growth, if I had to sum it up in a couple of words. So all that kind of buoyed the bond market a bit, but still a lot of uncertainty going forward about inflation. So despite the fact they have slower growth, we also have inflation pressures continuing to hold up.
And we'll get more inflation data next week. But, as we look ahead to the rest of this week, we had JOLTS this morning. We do have that Friday jobs report coming. Joe, for you, what are you expecting from the jobs report here? And how much of an impact does it potentially have on both the September meeting and then the meetings going forward?
Well, I think the estimate is for about 75,000 jobs created. So definitely kind of skewing towards the downside in terms of where that number has been. And then you look at the revisions that we saw over the last couple of months, it doesn't paint a rosy picture for jobs. The market's reaction today, I found very interesting because the market had a few setups in where, it could have been really positive. So, you had the Google announcement where they basically don't have to give up Chrome. That came out last night, and we saw the futures move off of that. We got the Beige Book and we got the job openings, which kind of pushed down the 10-year yield to about 4.2. Actually, at one point, we were trading 4.19. So definitely the bottom end of the range from where we've seen. But I think if you look at how the market reacted, yes, we're up, but the breadth, I think, is important today because you got about 2-to-1 decliners to advancers. Not quite, but almost 2-to-1 decliners to advancers in the S&P 500, and the strength is really just centered amongst a few stocks. So, when we get to some of this data that looks a little bit weaker, specifically on the economic front, that's when you see investors, and what they've been doing is they've been moving back to what they know, and what they know that's worked has been the Mag 7, and they're kind of eschewing some of the other names that had been doing well the last couple of weeks.
And I think we may have just lost Joe there for a moment. So, Kathy, I'll come back to you. As far as your expectations for the jobs report, we did get the JOLTS data today, signaling that there's, a weakening labor demand where we're having some issue. As far as September goes, still pricing in a nearly 96% chance of a rate cut in September. But what does the rest of the year and the rest of the cycle look like beyond that, do you think?
Yeah, I think the difficulty the market has right now, the bond market, is pricing in a series of rate cuts all the way down to about a 3% Fed funds rate next year. That's possible, but given where inflation is, given where economic growth is, given how easy financial conditions are, it may be too aggressive to price in that kind of a move. Now, we'll see more in the labor market. We do expect the Fed to cut in the meeting on the 17th. We've already basically heard that signal from Powell and other members of the Fed. So that seems pretty likely. And another one in December wouldn't be surprising. But you'd have to say that at that point, barring a big drop off in economic activity or a surprising drop in inflation, Fed funds would probably be about where they're supposed to be at that stage of the game. It was not a cycle where we're seeing a significant weakness in the economy such that you would expect big drag on growth, a big drop in inflation. to carry Fed funds down to 3%. So my concern is the market's kind of ahead of itself. We had a lot of choppy data. It wouldn't surprise me if the dominant trend just continues to be yield curve steepening as the market expects short-term rates to go down, but long-term rates kind of hover where they are.
And Joe, coming back to you, when we lost you there for a second, you were talking about sector performance. And at last I looked, only 3 of the 11 are in positive territory today. As far as what the technicals are indicating to you, what are you seeing in terms of sector performance?
Yeah, we're smack dab right there at the 20-day moving average for the S&P 500. And in terms of sectors that have outperformed, just today alone, it's 2-to-1 decliners in the S&P 500. Really, the only strength that we've seen recently has kind of been, you've seen a little bit in energy, you've seen a little bit in discretionary and some in financials, but in terms of technology and industrial, some, 2 of the sectors that have been driving growth through the majority of the summer, those have really started to give up a little bit. It's not something that causes concern, but I do think that it speaks to the fact that as the economic data starts to slow, investors continue to go back to kind of what they know, and what they know is the Mag 7, and that is what's powering today's move.
Well, that brings our big picture panel to a close for today. I want to thank you both for your time. That's Joe Mazzola from Charles Schwab and Kathy Jones from the Schwab Center for Financial Research.